All right, it's 12:01 here on Thursday the 14th. Welcome everybody. Thank you for joining us for today's TRU Snacks webinar, the latest in our weekly webinar series. Today we are joined by Emily Rickey, a partner in our Boston office, who's going to be talking about forecasting and planning for 2021, which is an interesting forecasting and planning year, certainly different than ones we've seen in the past. So looking forward to a lively conversation and hopefully some good questions as we go along the way as well. Couple of administrative points before we get started. If you've got questions, please pop them in the Q&A window as we go. We will answer some of them over the discussion, and we may hold some until the end as well, but we will answer all questions that come in. We will also be doing our usual snack basket giveaway from one of our local snack purveyors. So we'll do a random drawing during the discussion and announce that at the end. And then the marketing team will be in contact to get shipping information and all those sorts of things. So without further ado, I'd like to hand it over to Emily to talk about our topic today. Emily, over to you.
Great, thanks, Steve. Hi, everyone. Thanks for joining us. So as Steve mentioned, my name is Emily, and I'm a partner in our Braintree, Massachusetts office. I spend most of my time with owner-managed businesses, providing the typical attest services like financial statement audits and reviews. But I also have a big focus on how business decisions will affect both the corporate and individual tax situations, as well as advising and helping clients to navigate any of the various challenges that might arise for them. So during this webinar, we're going to talk about forecasting for 2021, how forecasting will be different this year, what items to consider, who are the users and what types of forecasts they might need, and then why forecasting will be especially important this year. So 2021 forecasting will be drastically different from any planning or projection work done in prior years. 2019 didn't equal 2020, and then 2020 will by no means equal 2021. So inputs and assumptions that may be held true in a quote unquote normal year, in which maybe you based your forecasts on a projected % growth or decline, with all of the other causal relationships remaining pretty consistent, won't really be the case. In previous years, forecasting or planning for the upcoming year was often looking at how history had unfolded and applying new factors, hopefully growth, to those actual results. Maybe there were years that were predicted to remain flat for sales, but the general operations of the company would remain relatively the same. So in 2020, though, most companies had to completely reinvent themselves. Over the last 10 or so months, I've seen most of my clients pivot and adapt in some way or another. To kind of give a couple of examples, e-commerce became an important sales channel for a seafood distributor. So most of their year-round business was chef-based, and when a lot of restaurants closed or had reduced in-house capacity with customers staying home and cooking in more, this client realized they had a potential new market. So they'd always had a really strong direct-to-consumer e-commerce business for the holidays, but they were able to develop and promote this type of sales year-round. And then another food distributor lost a lot of their nursing home and hospital type customers as cafeterias were forced to close to visitors. So they were able to pivot in a couple of different ways. They provided food products that were packaged for home meal kits, but more importantly, from a larger scale, they also began to target grocery stores for their direct retail business. And then another client, a commercial cleaner, so that's an industry we probably think would be booming during a pandemic like this, actually had to shift their business model as well. When many of the office buildings shut down as employees worked predominantly from home, the recurring office cleaning work that they had faded. So instead, they had to find ways to replace that, and they created a higher margin service with deep cleaning and use of ultraviolet clean machines. So they responded to outbreaks or for those essential businesses that remained open and now maybe required more frequent sanitizing. So this created a different margin mix for them to understand in their forecasting. And then the last example that I'll share was a paving and resurfacing company who was still deemed an essential business, but they lost the ability to complete some of their contracts for apartment complexes as more people stayed home with their cars in the lot. So instead, they were able to focus on another side of their business with municipalities and airports, who were using this kind of lower traffic time to complete some long overdue repairs, and that side of their business boomed. So for all of these businesses, they didn't really know going into 2020 or even halfway through 2020 for that matter, which of these pivots would really be successful. So they had to remain flexible and dynamic. I think businesses that were most successful with their 2020 forecasts had both short-term and long-term models. They applied probability estimates to various scenarios. And then they also ensured that their forecasts were really easy to use and update so they could alter the inputs for changes in expectation, which obviously arose constantly as they adapted to the changing environment. So because things are constantly changing, as we've all experienced, and each new venture might bring with it many new unknowns, it was important for all of these clients and everyone else to really revisit their forecasts more frequently. So quarter to quarter budget to actuals were vital to being really less reactive and more proactive for them. So what to consider for this year's forecasts? Under all of the client examples that we just kind of went through, as clients explored new customer base, mode of distribution, any different types of services or products, they didn't have the same margin and operating cost structure that they maybe had in previous years. So there were several new things for them to consider this year. In 2020, some of the expenses may have decreased, things like office supplies, utilities, travel, auto expense, marketing and promotion, but they might have been offset by increases in other areas such as IT support, hardware for working from home, cleaning, maybe COVID safety related costs. And there also maybe was a different balance in the use of direct labor versus subcontractors or a new mix due to new product lines. And then with the expanded e-commerce markets, the type and size and frequency of shipping might have changed drastically as well. So it's really important to recognize which of these costs will be recurring and then which were temporary to 2020. Another unusual circumstance of 2020 was the presence of all of these government grant or assistance programs. Some involved a straight cash inflow to a company. Others allowed for the deferral of certain expenses. So when evaluating a cash flow projection, businesses have to make sure that they're adapting the prior actuals for the inflows that won't be reoffered, or maybe they're available at a lower level this year. And also account for the timing of any repayment of some of those deferred expenses. So things like payroll taxes, maybe rent, leases, notes payable. And then they also have to consider a new cash outflow. So some of the assistance might be repayable as debt with associated interest, and that needs to be included in models going forward too. It's also key that you kind of consider what really contributed to 2020 being a different year. So in reacting to the shutdowns, maybe you used PPP funding or took advantage of these credits and deferrals to enable positive cash flows. Maybe you had a solid year in spite of it, but the backlog has dried up. Or maybe some of your precautionary or reactive measures, such as limiting bonuses, suspending 401k match, other measures like that enabled you to get by, but can you really continue to retain and motivate your employees without adding back some of these measures? So there's a lot of different things to consider here. And then one last item that's also important to consider, everyone's favorite topic these days, the effect of changes in tax rates. So both for C Corps and S Corps. Companies that experienced growth may have surpassed some of the eligibility requirements to be taxed as a small corp. And for C Corps, this has a dramatically different tax answer. Growth companies also may no longer be able to take advantage of certain tax provisions if their revenues have exceeded set limitations. And conversely, if your company unfortunately did not experience growth, there may actually still be benefits to having a solid adaptable projection for taxes. So paying in safe, this concept where you make your quarterly estimated tax payments based on the prior year results, might actually be an unnecessary payment of upfront cash if your results will end up being lower this year in 2021. So for these reasons, we actually have clients now in January who are already doing their 2021 tax planning using forecasts that they've prepared. So this proper planning and anticipation can actually save corporate tax deposits or distributions to owners, which cover the flow-through income and leave more in the business. So now that we kind of have some experience with working from home or a new customer market, new services, incorporating that knowledge into the 2021 forecasts will likely take more work. And obviously, if we've learned nothing else from 2020, it's that unexpected things will change. So your model for 2021 really should be easy to adapt and blend different scenarios that might unfold, whether predicted or unforeseen. You're going to have a lot of different users to balance too. So to respond to those users, you might have up to 3 different scenarios that are in use at any given time. There's probably going to be a best case scenario, an expected, moderately conservative scenario, and then a worst case scenario. So the expected forecast will be used for third parties most likely. Bottom line results will still be important to investors. Calculation of covenants is required by bankers, and maybe other metrics if there are planned mergers or acquisitions on the horizon. And then as we talked about on the previous slide, these expected results will also be helpful for ownership from a tax planning perspective. So given all the uncertainties of the political landscape and resulting tax law changes that are likely upcoming, it's important to make decisions that balance this flow of income and expenses against years of potentially higher tax rates. And this year, more so than ever, really, the cash flow projection with the expected scenario will be an important component to your financial statement engagement. So the COVID-19 pandemic is considered a triggering event, and the cash flow projections may be necessary to support that there hasn't been any impairment of goodwill or intangible assets or really any other long-term assets that you have on your books. And management also has to be able to substantiate that the organization will be able to continue as a going concern. So in some situations, this is necessary, and some might be surprised to learn that under new standards, the time period that has to be covered by these cash flow projections is 12 months from the date of issuance of the statements. It's no longer from year end. So if your December statements are issued in March, you really need a 15-month forecast through March of 2022. And that's something that we're trying to incorporate into our planning discussions with clients now, so that as they begin working on these forecasts, they can get ahead of it rather than really being pushed up against a financial statement deadline to prepare them. So communication is key here as to what's needed. Management will also need to use forecasts to make operational decisions. So, capital expenditures, when paused benefits can be restarted, things like that. And use of this worst case scenario can help to really bring to light a tipping point for some of these non-recurring costs. So the projections here might be relied on at a very granular level. Cash flow management of accounts receivable collections, vendor payments, those will be crucial to maybe keeping the lights on or people employed. And conversely, a best case scenario for management might be a useful tool for internal motivation. So salespeople are hitting targets, maybe they're looking to generate revenue from unexpected sources and really helping to push the company forward. So one thing to note that in potentially, juggling all of these different multiple scenarios, and even really when there's just one scenario in use, it's also a good practice to have a really well-organized assumption sheet so that it includes all the factors that lead into that specific forecast scenario, estimates of profit margin, headcounts, when there might be large payouts expected. This sheet really just reminds the preparer and the reader everything that was thought about and why it was made and what it's being used for. And this year more than ever, the forecast use will really be multifaceted. So in order to balance all of the decision-making factors, when you're making these forecasts, it's important to involve all departments and all user considerations. Each business decision is really often influenced by multiple factors at once. So you may be getting pulled to show increased bottom line for investors, but lower taxable income from ownership. And then there's a lot of metrics that you're trying to balance for bank covenants. And this is an area that we as CPAs can really assist with in getting all of that organized and well balanced. So why is 2021 forecasting especially important? I think that, business owners and management might feel as if you've spent 2020 scrambling, scrambling to keep the business afloat, scrambling to adapt to all these new employment laws and regulations, and really just scrambling to stay one step ahead of a constant barrage of really unpredictable events. So while 2020 was maybe spent flying by the seat of your pants and learning to adapt and survive, let's hope that we can use that lesson and be better prepared for anything that comes up in 2021. So forecasts will really be an integral tool for most of the internal analysis performed by decision makers, payback analysis for bank debt, modeling scenarios and buy versus lease for new equipment, maybe downsizing office space, lots of other areas like that. I think in prior years, these decisions could maybe be made more easily, but now there are a lot more factors and unknowns at play. So for example, what will the vaccine rollout timing really look like, and how long will it take for various industries to return to normal? Forecasts for 2021 will also play a part in determining certain adjustments that are going to be made at year end for financial statements. For example, inventory on hand at year end will need to be evaluated. And I think this will be especially important this year for a lot of different industries. Some manufacturers, were maybe forced to switch gears a bit. They maybe turned to producing PPE like masks or sneeze guards or hand sanitizer, something different than their typical finished good products that may have become unpopular during the shutdown. So while raw materials are adaptable, any finished goods inventory that's still on hand in kind of a shuttering industry wouldn't be sellable. And the other thing is that if there was poor or inaccurate forecasting from 2020, that may have driven up inventory in stock or maybe created over purchasing of inventory around year end. So it's important to kind of do that full analysis of sales projections for 2021. And then if a valuation analysis or a write down might be needed in 2020, we need to get the reserves in place there so there's not a trickle down effect, really continuing to drive margins down in 2021. And also from a financial statement support perspective, with a lot of companies having obtained a payroll protection program loan or a PPP loan, the buzzword we're all very familiar with. So in 2020, if they obtain that loan, and you're probably calculating full forgiveness due to the extension of the cover period from 8 to 24 weeks, there's really a good deal of forgiveness income to account for on the financial statements. And companies do have two choices of acceptable accounting methods to account for the loan and the related forgiveness, even if the formal forgiveness hasn't been obtained by year end. So treating the PPP loan as debt in 2020 and then forgiveness income in 2021 is always an option. But another option is to account for the forgiveness income in 2020, or the year in which the related covered expenses were incurred by using a management estimate. So without 2021 forecasts, management may not know which year would benefit more greatly from this forgiveness income. So beyond just a simple bottom line or EBITDA calculation, debt covenant projection should also be incorporated into the forecasts. Really just to determine when the forgiveness income should be recorded, given that companies do have a choice in their accounting method. So one client I have, a school, suffered some enrollment declines going into 2021 and their junior end. So we were able to work with them and help with forecasting, which obviously included the typical cash flow modeling for the next school year and the related financial reporting period, but we also incorporated those EBITDA and debt payback scenarios to ensure that they'd meet their covenants in both 2020 and 2021. And I think using this model, they were really able to determine which year the forgiveness income was most beneficial, and they could maximize the reporting choice that was available to them. So even if your company had a banner year, I think forecasting can still play an important role. As you wrap up the 2020 year end with positive results, you might realize that this pattern won't continue into 2021. So backlogs could dry up, customers might be forced to tighten their own budgets, and then collections from customers might start to prove more difficult as others have their PPP loan proceeds dissipate. So if there is going to be a need for additional capital, perhaps midway through the year, it's advantageous really to reach out and begin that process now when the results are positive versus 6 months later when sales may have faltered and things are already getting tight. And then I think kind of overall, regardless of 2020 results, just the overall pulse of the lending industry has become increasingly stringent. So banks are looking to forecasts and cash flow projections now more than ever to help determine loan amount. I think even asset-based lending now incorporates more EBITDA measures than in the past. And then cash flow forecasts are also even more important for credit line renewals this year too. All right. So all in all, hopefully I've convinced you that forecasts are vital to successfully running your business and making sound decisions. Despite all of the intricacies and challenges that might arise with 2021 forecasting, being prepared will really pay off in dividends. And I know there's a lot of factors to consider and users to balance, and it might seem overwhelming and be a bit of a what comes first situation. But again, this is where CPAs and advisors can really excel and add value. So we have experience obviously with many different types of client situations, and we can help to pose questions or points for consideration. We can help with modeling and decision support as well. And then really, once you have these forecasts and models in place, it's also important to be able to use them to set your business up for success. So looking at various aspects of your banking relationships and kind of incorporating those needs into your projections will be key. There's consideration of borrowing-based calcs, covenant compliance, changes in working capital needs, potential buyouts, those things that might come up for you. So I think too, you may also end up in a situation where your forecast is showing that you need to find solutions to keep your business going during a continued downturn. And just want to point out that there are some new relief provisions that were included in the Consolidated Appropriations Act of 2021, which was just signed into law in late December. So this might have some applicable provisions that can help. Current PPP first round borrowers can reach full forgiveness on their existing loans through expanded eligible expense categories, so that if you're not getting full forgiveness, that will reduce any payments out. Eligible borrowers can reapply for this initial round or access a second round of PPP loans with expanded covered periods and expenses. And then the taxability changes to PPP forgiveness might change what you have done for your tax projections for Q4 estimates and leave a little more cash in the bank. And then there's also a provision where the employee retention credit may now be available to an expanded pool of applicants. Previously, it wasn't allowed if you'd also taken a PPP loan, but it is now allowed for businesses who meet certain eligibility requirements. So you can qualify for various credits for both 2020 or 2021 per employee. And it may prove pretty advantageous if you meet the kind of revenue decline levels, headcounts, other requirements like that. So we're happy to talk in more detail about what this could mean for your company. So to kind of end, be proactive. If we've learned nothing else from 2020, it's really that you can't predict the future, no matter how much you plan, but position yourself so that you're ready to react with all of this forward thinking information and the tools to make decisions as they come up. All right, I don't know, Steve, if we have any questions that come in that I can help to answer.
We sure do. A couple that have come in and a couple that came in earlier. So first question, Emily, is, obviously the financial dynamics of COVID and coming out of COVID and going into COVID and all these sorts of things hits different sectors differently, right? Mm-hmm. So can you talk a little bit about some of the sectors that have more complications with their forecasting models and any tips that we can provide to those types of companies?
Sure, yeah, that's a great question. I think with some of my focus being in the manufacturing and distribution space, retail and then distributors often struggle with demand forecasting for their inventory levels. I'd say specifically industries that are, have a more difficult to predict traffic or sales levels, the restaurant, tourism, and hospitality right now might find it difficult to forecast. So I think finding a really a short-term model that directly interfaces with your accounting software is important so that things can be updated quickly. Weekly as things are changing, you're able to kind of link that into your forecast and move forward and adapt. I think other sectors that have maybe a very narrow supply chain or really highly dependent on other environmental or political factors will have a more complex set of assumptions that are going in. So I think, again, in these situations, applying, probability factors to the various scenarios will be helpful to just see how things play out and balance all those unknowns or, interdependency issues.
Yeah, that's great. And just a reminder to everybody that we do have a couple minutes left, so we do have some time for Q&A. If you want to use the Q&A window at the bottom of your Zoom screen to submit them, we can address them now. Another question for you, Emily. You gave a couple of good examples. You talked about the school. You talked about a couple of your other clients. Any other sort of stories or anecdotes we can give just to illuminate the importance of this sort of activity right now?
Sure. Yeah, so there was a recent situation in our office where a client kind of came in mid-December, really needing some immediate forecasting help. So they were a restaurant group that had a focus on tourist type locations and event space. So obviously in an industry that was hit especially hard this past year. They had just purchased one of their locations back in January, right before the pandemic hit. So they had a new mortgage to balance some additional payouts. And obviously their sales, in being tourist focused, are pretty seasonal. So what they make in the spring, summer, and fall is really what gets them through the winter. And they were in a bit of a tough situation. So with shutdowns through June, and they burned through their PPP funds, and they were in their 500,000 line of credit, something they didn't usually even borrow on, and they needed to have a temporary increase to the line. They went to the bank. The bank initially said simple P&L balance sheet would kind of be all that was needed, but then at the last minute, the bank came back and said they actually needed a cash flow projection, prospective balance sheet, things like that. So this company wasn't really prepared with that information. So a team in our office was really able to step in quickly, and they created a 13-week cash flow model. And I think more important than just creating the model, the way that they created it was really easy for the client to update, and kept in mind who the user was, the bank, what they wanted to see. So I think that was important for them. They did a lot of write-ups of all the assumptions, and it was really clear. And then this model interfaced directly with their weekly flash reports from their point of sale system. And as they've moved forward, they've been able to continue to update the bank, and they were able to get a $2 million increase on their line to keep them open through the winter. So I think, again, that's a great example of having cash flow projections ahead of time would have really decreased some of the stress that went into all of these preparations and decision making.
Yeah, exactly. No, that's perfect. That's perfect. And you just touched on it a little bit, but where does technology come into play here? What should companies think about from a tech perspective if they're just trying to get started with better FP&A processes?
Yeah, so I mean, I think that what we use a lot of times is Excel, and that's something that is pretty easy for companies to. Everyone has Excel. You take your reports out of your accounting software and kick it into Excel for that 13-week, link all the tabs up. And that is something that's a pretty easy thing for users to do. But I think there are, now a lot more solutions that are a little more dynamic and really give better answers. I don't know, Steve, you might actually want to talk about some larger solutions. That's a little more of your specialty.
Leading question. Leading question, yes, yeah. No, I think that's right. I mean, Excel is usually, especially if you have to get started quickly, that's where we usually start, right? Yeah, we've seen a bit of an explosion in the performance management space. So EPM or CPM solutions, they're called, enterprise performance management. So we've been working with a lot of companies who need, to your point, faster, more dynamic, more structured, and sometimes more bottom-up types of approaches where they're taking forecasting information from a wider range of people. So we've been standing up EPM solutions for clients to help them do that and tie together all their different sources of data that can support it on more of like an operational basis going forward, take some of the pain and the risk out of running everything off Excel spreadsheets.
Yeah, and I know we have a client in common who you help them kind of on an ongoing basis with some of their internal reporting too, and just saving time and having to, make all those corrections in Excel and get stuck in a formula. So I think it's, firsthand from experience how much time and headaches some of your solutions have saved them.
Oh, there you go. There you go. Perfect. Yeah. So listen, Emily, thank you very much. Great session today. Very, very important topic and a good one to start the year off with for sure. So the couple other notes here. We've got our next TRU Snacks sessions on the schedule that I just wanted to give everybody a preview of. So on the 21st, we have best practices around buy-side due diligence. We're going to be joined by, I believe, David Sawakowski out of our TAS practice to talk about how you should be preparing for that. We've got the January 28th. We just added this, not on the calendar yet. We're going to do a PPP round 2 overview. Just starting to get the guidance on that. It's just rolling out really starting tomorrow. So we think by the 28th, we should have better guidance and some feedback to be able to talk about for 20, 25 minutes at the same time. And then on February 4th, we're going to be talking with Joe Cashel, who's the head of our turnaround and restructuring practice, about what you should be thinking about if you're facing a turnaround situation. So that's what's coming up. Please visit our website. Make sure you're signed up for the TRU Snacks invites on the TRU Snacks mailing list. We will be sending out a recap of this as well as posting the video for anything that you want to reference back to, or if you've got people in your company or network who you think would benefit from it. Please feel free to share this video with them. For any questions on today's content, reach out to Emily directly. Her email address and phone number are up on the screen. And big drum roll for the winner of today's snack basket is going to be Lisa Cariulo from Alliance Media Group. Lisa, congratulations. Enjoy your snacks. And somebody from our marketing department will be reaching out shortly. Folks, thanks very much for visiting with us today. We hope you have a great rest of your week and weekend, and hopefully look forward to seeing you next week. Take care.
Thank you.